Hello, this is Josh Belk with the Belk on Business podcast. Appreciate you once again taking a few minutes to listen in today. Primarily, I'm going to recording this to send out to our clients, but I thought it might be helpful to kind of go ahead and send this out on the podcast platform as well. And we're going to really get into, and there's no way in the world that we can get into any sort of depth on this. But I want to kind of just take a moment. The last couple years, at the end of the year, I recorded a kind of a year-end tax planning type video and sent that out to our clients. And I think it's also been distributed on our podcast platform in the past, but and on others as well. But I want to take just a few moments here to kind of just touch base on where we at in 2020 as it relates to as far as some tax. Basically some tax changes we've seen this year, some laws that have been put into place, and of course we're all feeling the impact of this whole coronavirus, COVID-19, this pandemic situation, and it's affected all of us in very different and personal ways as well. And as I kind of look across the spectrum of our clients, of course, this year has brought on all kinds of conversations that I never thought that would end up having in business. And of course, we ended up with our tax deadlines for 2019 extended, and which was kind of a blessing because we ended up having to really kind of help clients maneuver through the PPP situation, which I'll talk about here in just a moment, and then also some other areas in their business. We did have some of our clients who essentially just had to close their doors, so to speak, had to basically just close their businesses up. And fortunately for most of our clients, they went ahead and are working through it. But I think it's helpful for us just to take a step back, take a moment, and just kind of just walk through what we're dealing with as of right now. Some things we do know, other things we simply don't know. So we saw a unique situation that relates to the CARES Act, which I'll get into in a moment. At the end of last year, we saw the Secure Act, which did make an impact. I'll talk about that here in a moment. And then I'll talk about our payroll tax filings, and then give you a brief update as it relates on the personal space, just kind of give you a little bit of a high-level outline as we work through this. So first of all, the Secure Act, and this, like I said, this is not at all comprehensive. I'm going to hit some highlights, and really when it comes to tax planning, I would encourage you not to take everything that I say on this particular podcast and go out there and utilize it. I think it's extremely important for you to have a conversation with your accountant and to make sure that everything that you do aligns with what's going on in your business, and that it really kind of, I think even more importantly, helps get you to your goals, your business goals, and tax is just one of those strategies. It isn't an end all into itself. Some people say, I don't want to pay any taxes. And that is a strategy. Usually it's not a good one, but it is a strategy that you can have. So this is meant to be kind of just one tool in your toolbox to be able to help to get you to where you want to go. So this CARE Act. Required minimum distributions, and if I use some terms here and you don't understand what they are, that means it probably doesn't apply to you, but it may at some point later this year. So required minimum distribution age was increased to 72 years old. So basically, historically, it had been 70 and a half, and you had to begin taking withdrawals at that point. That age has been increased to 2020. Inherited IRAs, and we have a number of clients who utilize inherited IRAs as part of their overall finance strategy and their tax strategy. But inherited IRAs have the rules on that have been changed. It used to be you would take out the distributions over the lifetime, the life expectancy of the decedent. In this case here, that time frame has been decreased down to 10 years. So you have to essentially drain that account over 10 years. And of course, there are some exceptions to almost all of these rules. The inherited IRA by the spouse would be an exclusion. There are some 10-year age difference guidelines as well as children rules in there as well that are also exceptions. But as a general rule, you have an inherited IRA. You can no longer utilize the life expectancy of the decedent. You now have to withdraw the account or drain down the account over 10 years. The CARES Act. I think this more than anything else has been the source of a lot of what we've had to deal with over these last few months. So one question that we've had a number of calls on was this 10% removal as far as from early withdrawal from an IRA, and also the $100,000 rule from a retirement account. 401k, 403b, and the IRA. So a 10% early withdrawal penalty essentially being waived, but it's for COVID-related reasons. And so there are people out there, and sometimes just clickbait, whatever the case may be, that put information out there. Hey, you can withdraw $100,000 out of your retirement account. And then you just kind of leave it at that, and instead of kind of explaining what those rules are. So it has to be for a COVID-related reason. And so the IRS hasn't given exact guidelines on this. They kind of, if you were to go to their Q&A page today, it would refer back to the reasons that we saw back in Katrina, back in 2005, and it has some other information on there. But bottom line, if you were affected, you had an employee that was infected, you had a layoff, a business closure, some of these like direct impacts that are very measurable. In all probability, it would qualify for the early distribution from your retirement account without the 10% penalty. Now, in regards to the $100,000 that being borrowed, the same rules essentially apply. So you take the $100,000 out, it would need to be repaid over the next 3 years. And if you repay it over the next 3 years, then then you essentially would not have the tax. And so this is going to be a process. So if you're looking into taking out the $100,000, doing something else with it, put the money back in, which can be used as a strategy to do other things. Okay, you have to ask the question, number one, do you qualify? And then secondly, make sure you have the plan in place as far as paying it back. And then kind of realize the ultimate consequences if you don't in regards to taxation of those funds being distributed. Another thing you need to be aware of: not all plan sponsors are permitting these COVID-related distributions. So if you work for a company, they may not permit for you to pull the money out. I know more and more sponsors are working on it to try to be able to have those distributions, but you need to be aware that you may end up with a little bit of a hurdle there if indeed you do qualify. Employers can pay and deduct up to $5,250 of employees' college loan, tuition, fees, books, etc. Something I don't hear talked about a whole lot. That might be an opportunity there in your business. Next, let me give a brief update on the whole Paycheck Protection Program, the PPP. Of course, the goalposts on this have been moved a number of times. Now, at this point, we're kind of back into the position of having some serious unknowns as it relates to what ultimately is what this is going to look like. So initially, and I actually did a couple different podcasts on the PPP. Initially, it was basically the SBA or your bank would go, they look back in the application, they would look back at 10 weeks of your average payroll. You'd have 8 weeks to spend it. You'd have to spend 75% on payroll. The other 25% could be spent on some admin cost. And then some qualified cost. And then if you met the standard, then it would be waived. Then they came back, and now they've extended the spend over 24 weeks. And then the number for payroll has been reduced to 60%. And so now the issue that we're going to have, especially those who are receiving the PPP loans later, that this is going to spill over into 2021. The other issue that we have is in regards to the forgiveness component. Even though the SBA has come out with the applications, most banks are not accepting it. Applications as of yet, they're still sitting on the sideline to wait and see if Congress is going to come back, or the SBA, somebody's going to come back and say, okay, we're going to categorically forgive all PPP loans under $150,000. And then at that point, you can go ahead and get forgiven. So for most of our clients, they're under that $150,000 threshold. If you're over that threshold, I'm not going to get into that in this podcast. I would encourage you to go ahead and reach out to your accountant. Go ahead and begin working through making sure that you have all of your ducks in a row. But for most of our clients, it's going to be a fairly simple process as far as filling out the application, getting the paperwork in. But the issue is going to be the timeliness of the forgiveness. So the directive we've been given so far is that if you receive the PPP loans, that is not going to be added to your income, but it's going to be a decrease in expenses. So I'll give you a simple example. So you receive $50,000 in PPP loans. So you have that $50,000 loan. Essentially what would happen, so say you spent $45,000 of it on payroll, the other $5,000 on rent. So instead of increasing your revenue by $50,000, you're going, in this example here, you would reduce your payroll expenses by $45,000 and decrease your rent by $5,000. The net effect of this is the same. But I think it's important that you realize that $50,000 in this example is essentially going to become taxable income to you or your business. Okay, so you need to realize that you do have that exposure as you kind of go through the planning. The big question that we still don't know at this point is if the loan is not forgiven until next year, are we to reduce the expenses this year, or do we reduce the expenses once it's been forgiven? My hope is we have absolute clarity. I think we will before year end. We're able to get the applications in, get the forgiveness component in. We make the adjustments as it relates to on the tax side, and we just at that point begin to move forward. So that's kind of where we're at as of this point. EIDL loans, we've had a number of clients take on the EIDL loans. If you did get the advance on the EIDL loan, so it's basically $1,000 per employee up to 10 employees, that can be forgiven if you did not get the PPP loan. If you did get the PPP loan, that advance would need to be paid. The remaining amount of it essentially is basically a 30-year loan that's amortized over 30 years with a pretty favorable interest rate. And both the PPP and the EIDL still available as of this recording. I think probably by the time this gets out, the PPP may have stopped unless they go ahead and extend or do another round of funding. Net operating loss carryback. This is another provision in the CARES Act that we received a number of questions on. I was actually on a call this last week. On a tax summit call, we really dug into this and into a lot of ways. And once again, this is a very complex conversation. But I'm going to kind of approach it at a really high level. If you're essentially had a business that ended up with a net operating loss, or you individually end up with a net operating loss, you may, and I'm not going to say you absolutely can, but you may end up with a situation to where you can actually go and carry that back. When we had the Tax Cut and Jobs Act put into place, it was passed in late 2017. It removed the carryback provisions of the net for the net operating loss, So now it's been added back. And so now we have for 2018, 19, and 2020, you can actually go and carry it back 3 years and then carry it forward from there. So if you end up with a net operating loss, you can go back, amend your returns. Now, it's one of those things you have to go back 3 years, so you can't select the years that you're going to utilize the net operating loss. So you have to go back 3 years, carry it forward. So in this case here, if you're able to amend your 2018s, you go back and you would then at that point carry the loss back to 15, 16, 17, and then if anything is left, carry it forward from there. Also, one other provision from the Tax Cut and Jobs Act was a limitation on 80% of income as it relates to the net operating loss. That has been lifted for 2018 and 2019 and 2020 only. So once again, I would expect that these all of these rules will expire at the end of this year. Then we'll kind of go back from 2021 to 2025. The rules would go back to the way that they were at the end of 2019 or early part of 2020 before the CARES Act was passed. Now, I do want to make a comment here that we are an election year. And so we are going to see a situation. It's going to look a lot different if we end up with candidate Biden winning the presidency versus if President Trump ends up retaining the White House. Just kind of be very aware that a lot of these things can change. Kind of a little joke on the call this last week, and one of the gentlemen on the call actually made the comment as far as are we Biden-proofing our portfolios. One thing that we do know, and I'm not making a political statement here, it's just a matter of fact, if you've looked at his policies, that if we do end up with Mr. Biden as president, taxes are going to go up. He's already talking about removing 1031 exchanges. A lot of our clients are real estate investors. That's going to have a big impact on them. So there are going to be some changes there, and they're probably not going to be favorable for a lot of business owners. And so take that, you may disagree with me, but I think the facts would prove otherwise. So just kind of be aware that as you kind of go through and do your planning for this year, kind of realize that if we end up with a kind of a change in the White House, a change in leadership in the fall, that we might very well be having much different conversations at the end of 2020 than we would be having now. You also do need to be aware that with the net operating loss that there are some passive activity exceptions there. So if you aren't materially you're not materially participating in the activity. Now there are rules out there as it relates to hours and things of that nature. I'll just give you the kind of the general definition. So that passive activities include trader business activities in which you don't materially participate. You materially participate in an activity if you're involved in the operation of the activity on a regular, continuous, and substantial basis. So if you have a passive activity that you don't materially participate in, it has a huge loss, you are not going to be able to use that as part of the net operating loss calculation. Okay, so just kind of be aware of that. And once again, if you're going to go through and you're going to utilize these rules, make sure that you're having a good conversation with your accountant to make sure that whatever it is that you are doing does qualify. So next, we're going to talk about kind of transition a little bit to the Employee Retention Credit and the Family First Coronavirus Response Act. So these two provisions were put in place as far as to try to help employers and employees as it relates to some tax credits. So from the employer side, the Employee Retention Credit, a business can take up to 50% of wages capped at $10,000 per quarter. If restricted, if basically business operations were restricted due to basically a government order. Okay, so it's capped at the $10,000 per quarter, 50%, or if you've had a 50% decline in your gross receipts, that would also qualify. So either the government, due to government restrictions, you were shut down, or you have a 50% decrease in your top line revenue. This particular credit is there. So both this credit and the Family First Coronavirus Response Act, if you receive the PPP, then you would not be able to take these credits. So just kind of be aware of that. Okay, so there is the Employee Retention Credit out there. So if you didn't receive the PPP funds, or during the timeline that you were not spending those PPP funds, I also want to qualify that, that you may be able to take one of these credits. So the Employee Retention Credit, so it's up to 50% of wages capped at $10,000 per quarter. Provided that you were either you were shut down due to government restrictions, or you had a 50% decline in your overall gross receipts. The Family First Coronavirus Response Act, up to 2 weeks of paid sick leave for COVID-related reasons. So you end up with an employee that basically had to stay home because of COVID, had a family member. Their child's daycare or school was closed. There's a number of different reasons here that you can receive up to paid 2 weeks of paid sick leave. Now, depending on the reason, depends on the credit. So this is pretty complicated. If this does qualify to you, make sure once again you're working with your accountant, or make sure you have a really good understanding of the credits and the rules before you go and complete the 941s. Now, some of the things I'm going to kind of just give you an update is some of the things that have not changed or just been slightly tweaked. Some of these get talked about just about every year. First, long-term capital gains rates are still the same. So we have the 0, 15, 20% limits. The 3.8% surtax on net investment income still in place. If singles over 200,000 or married couples over 250,000. 401k limits for this year, $19,500 if you're single. $19,500, $26,000 if you're over 50, if you're single or married. So 401k limits are there, $19,500 if you're under 50, $26,000 if you're over 50. I'm not going to get into Super Roths or Super 401ks, talking about that here. Next, IRA limits are $6,000. If you're under 50, $7,000 if you're over 50, and that's assuming your income limit is under $74,000. If you are single, $104,000 if you are married. Roth IRA limits, $124,000 if you are single, and then $196,000 if you are married. Once again, you can always be aware of the backdoor Roth. So if you're over the IRA limits to be able to take the deduction, you can still contribute. And then if you're over the income limits for the Roth, you can just simply backdoor it. Once again, that may probably a situation you want to talk to your accountant about. Standard deduction for this year has been increased, $12,400. And then if you're single, $24,800. If you are married, the SALT deduction, the state and local income tax, is still capped at the $10,000, and there's still no 2% miscellaneous deduction still for this year. And then last couple items here, charitable contributions now are increased to 60% of your adjusted gross income for this year. And then there is going to be a $300 above the line deduction, which is something that I have never seen before, but a $300 above the line charitable contribution deduction. HSA limits, health savings accounts limits for this year, $3,550 for an individual plan, $7,100 for a family plan. And then the SEPs are still in place, simplified employee pensions. Still 25% of your payroll for a max contribution of $57,000, something that we have a lot of our clients utilize, especially if they have a smaller business or just a husband-wife owned business or single person owned business. They're especially helpful to be able to really contribute a ton of money into retirement. So kind of a takeaway, just be really aware of the rules. This may be a good year to consider doing a rollover from a traditional to a Roth. Those should be regular conversations that you're having or things you should be considering. If you have a lot of money in a traditional plan, moving it over to into a Roth plan. So I just want to kind of just highlight a few items that you may want to consider having a conversation with your accountant about, just to make you aware of them. For our clients, I appreciate you working with us, and I love working with our clients. I encourage you, if you have any questions, go ahead and reach out to us. More than happy to go ahead and schedule a call, look at your situation, see what we can do to help as we move into quarter number 3. Hope all of you have a wonderful day. Once again, I thank you for listening. This is Josh Belk with the Belk on Business Podcast.